Welcome to Trading Nation. I'm Mike Santoli. The S&P 500 on track to close its best quarter since 2013. So what's next for the markets heading into the fourth quarter? We're joined now by Ryan Detrick, Senior Market Strategist at LPL Financial. Ryan, good to see you. Thanks for being here.
Hey, thanks, Mike. I'm glad to be here also. Appreciate it.
All right, so as we make this turn into the final quarter of the year, market looks in good shape, right? S&P up 9% year to date, making new highs with less than 1% from a record high. On the other hand, we're being chased by some of the same concerns that we've had for a while, right? Is this peak growth for earnings and all the rest of it in the Fed? So what does history tell you about entering this particular period? We're heading into October in a midterm year. What should we expect?
Well, Mike, right here, we are entering October, right? And besides the fact it's my birthday month, I want to talk about that for a second. 1929, 1987, 2008. People hear October, they remember these spectacular crashes. When you look back in history, October is really not that bad. It's about an average month. But Mike, here's where it gets good. The last 20 years, October for the S&P 500 is actually the strongest month of the year. Also, we're in a midterm year, as we all know if you watch the news. Going back to 1950, October is the strongest month again, looking at midterm years. Since 1982, October to midterm years only been down once. So October is really strong seasonally all of a sudden, especially midterm years. Now we're up 6 months in a row, so maybe something can change here. But all in all, the bold trend still looks pretty good to us.
I was going to ask you actually how October looks when September has been good, right? I mean, September, we were told 30 days ago, maybe sometimes it's a little bit dicey. That didn't play out.
That's right. And back to that for a second. I think I was on with you guys a month ago talking about that. When September starts above its 200-day moving average and you have some strength into it, usually does just fine. October's similar. Now, here's the number I was just crunching before I came on. Going back to 1928. There's only been 5 times we've had a 6-month win streak heading into October. Obviously, that's rare. We all know sell and may go away. Usually, you have some down months now. Sure enough, though, 4 of those 5 times, the S&P was actually higher in the troublesome month of October when you have a 6-month win streak heading into it. So these are just lots of numbers and ways to look at it, Mike. But the bottom line is I've been coming on with CNBC for a while. The fundamentals continue to be strong, earnings are still strong, and the overlying technicals, it's still a broad-based rally. Technology pulls back a little bit, healthcare and industrials take over. That's what a bull market does. Certain groups take that baton, and things are still good. But again, up 6 months in a row, let's be honest, we could be due for a well-deserved break. But November, December still look pretty strong, and we expect stocks to outperform bonds once again in the fourth quarter here in 2018.
So it seems like a lot of these studies that you do, Ryan, they do come down to if the market is in an uptrend, if the market seems like it's behaving like a bull market, it tends to continue behaving like a bull market. Is it almost that simple?
It almost is. And something else, Mike, that's incredible. For 3 months now, the S&P has not had a single 1% move either up or down. You got to go back to last year in 1995, the last time we saw 3 months with really a market that dull. At the same time, if we read that, all you read were the headlines, you'd have no idea. So sometimes it takes, this is important for investors to note, maybe take a step back from the scary headlines and focus on those fundamentals, because that's really what drives us. And a market making new highs normally continues to make new highs as long as you don't fall into recession. At LPL Research, we do not see a recession over the next year or so. That's why we think stocks can continue to trend higher here.
You mentioned before, if one group pulls back, another one seems to take up the slack. That has been the pattern for a while now. I do wonder, though, if you're looking at the market being a leading indicator, do we make anything about some groups, whether it's housing, autos, airlines, semiconductors, that have kind of lost their leadership position or are struggling pretty badly?
Yeah, semis is the one that we're watching closely. Obviously a big part of technology. They've kind of gone sideways all year. Now, they also had a huge rally in 16, 17. Maybe they're just catching their breath this year before they go higher. But all in all, just look at those advanced decline lines on various indices, still at all-time highs. Usually see the advanced decline lines going down between 6 to 12 months ahead of an ultimate market peak. We're still making new highs there. We still have 20% earnings growth this year, 10% earnings growth expected next year. You've never had a negative S&P 500 with 10% earnings growth going back to at least 1990. So again, lots of reasons to think this bull market can continue. We're not naive to a lot of the concerns that are out there. Specifically, we've had a big rally, but the fundamentals are still there, and we think it justifies this move and probably a little move higher as well over the next year or so.
All right, Ryan. Well, if we don't talk to you in the next few weeks, happy birthday, Ryan Detrick of LPL Financial.
Appreciate that.
Thank you for joining us today. And thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.